Hello guys, welcome to this lesson on trade mechanics and identifying market flow and price trends. So these are some fundamentals that you need to know as a trader when you begin your trading journey, right? When you enter orders to understand how much capital is being tied up in a trade, things like margin call, maintenance margin, risk reward, and so on. Okay, without further ado, let's go into trade mechanics. So what is margin? So whenever you open an account, right, the broker will give you this thing called a margin. A margin means that if you have a $10,000 account, okay, let me just write it over here. Let's say you have a $10,000 account, 10K account. If the broker say that they're going to give you a 1:2 margin, it means to say that you can trade up to 20,000. That means it's like the broker giving you an leverage on your account, right? Okay, if we say I'm going to give you a 1:3 margin, it means to say that the broker gives you additional 20,000, which means to say that your 10K account can trade up to 30,000. Okay, so another words of saying that is that for 1:2 leverage, we can also say that it's a 50% margin. Okay, or 1:3 leverage, we can also say that it's a 33.3% margin. So when you say that the broker gives you 50% margin, it's the same as saying that the broker gives you 1:2 leverage factor. Okay, so in any trade that you do, there's going to be certain amount that is going to be tied up in your account. Okay, so I'm going to give you an example over here for, let's say, Apple, AAPL over here, Apple shares. Okay, so let's say Apple share price is at $200, and today you as a trader, you want to buy 100 shares of Apple. Okay, so if you buy 100 shares of Apple at $200, what's the value of this trade? So we say that the value of this trade is $200 times 100 shares, which gives you $20,000. So the value of this trade is $20,000. But do you need to have $20,000 in your account? Okay, let's say the broker requires 50% margin. So remember what I say over here, if the brokers say that they're going to give you 50% margin, it means to say that they are giving you the same as a leverage factor of 1:2 over here. Agree? So it means to say that if the trade value is 20,000, you only need to have 10K. Sorry for this, let me just drop this away. You only need to have 10K. $10,000 to put up to do this trade. And let's say that you have an account, your account balance. Let's say when you start trading, your account balance is 10K. $10,000, and you buy 200 shares, or sorry, 100 shares of Apple, and this requires you to put up 50% margin. So your entire 10K account will be tied up for this trade. So you can do this trade, but the entire balance will be tied up. $10,000 will be used to initiate to buy 100 shares of Apple at $200. Okay, so what is this thing called a maintenance margin? A maintenance margin is basically a level where if it drops below this maintenance margin, the broker will give you a margin call to top up back to your initial margin. It's like a safety net for the broker in case the share price, no, they lend you the extra $10,000 to trade, to put up to open this position. If your account goes, if the position go against you, right, your value of the trade will definitely decrease. So they do have this thing called a maintenance margin, that if your position, the trade value drops below this particular level, you have to top up. We call it a margin call. So you will be requested by the broker to do a top up to your account, right? If it drops below the maintenance margin. Let's say the maintenance margin is at 50%, same as the initial margin over here, that when you put on the trade. That's 50% as the maintenance margin, that will be the same as $10,000, right? So let's say today, when you buy Apple shares at $200, okay, and unfortunately, let's say Apple drops to $190. So Apple basically drops $10, right? And because you have 100 shares, so that will mean that you are losing how much? $1,000. So your account balance will be back down to from $10,000 minus $1,000. That will be your account balance will drop to $9,000 because Apple share price dropped $200 to $190, dropped by $10. It means to say that your account will have a drawdown of $1,000 and your account balance will be left with currently $9,000. However, the maintenance margin that you need to hold this position is 50% of the original trade value, which means to say that you need to have at least 10K in your account. But now your account is at $9,000. So what happened? So now the broker will give you a call, right? Your brokers, whichever brokers that you trade with, will definitely give you a call, okay, and to ask you to top up additional $1,000, at least $1,000 above, so that you can continue to hold the position. So most likely the broker will give you less than 24 hours to do the top up. And if you fail to do the top up, you can't tell the broker that, hey, you can't close my position, if not I will not trade with you anymore, right? Because this is part of their risk management, and it's something that all brokers are mandated to do, okay, to protect their own account as well. Because if the clients, the traders go bust, the broker will have to still pay up to the exchange. Okay, so if you didn't, let's say the broker give you 24 hours to top up the maintenance margin, to top up the additional $1,000 because of the drawdown, okay, you can either close your position yourself, and if you continue to hold position and after 24 hours, okay, the timeline that the broker gives you, the broker will go to your account and do this thing called a forced liquidation. So basically a forced liquidation means that the broker will liquidate your position. That means sell off your position to meet the margin calls, basically to reduce your position, right, to cover the excess, right, of trade value because you fall below the maintenance margin. Understand? So in all accounts, you will have this thing called a margin and margin call. So as a rule of thumb, do not use more than 80% of your account, right, margin. Okay, do not use more than 80%. Let's say you have a $10,000 account, do not use your funds up to more than $8,000. Leave a bit of buffer in case certain positions go against you, and so you will not be hastily have to go and top up your account. Okay, so just let me share with you my Interactive Brokers and my Thinkorswim account. Okay, over here. Okay, just so this is my Interactive Brokers account. As you can see, I mostly use this thing called the Web Trader, right? Interactive Brokers, I use the Web Trader to initiate my positions for swing trading or even short-term trading. So as you can see over here, this is the net liquidation value, creates the entire account balance. And on the right side, you can see over here, there's this whole section on margin requirements. So margin requirement means that currently how much margin I have is locked up in my account. Okay, so currently my stock with securities means stocks and commodities means the futures positions. So initial margin currently is locked up 80,000 80841. So I do have a big buffer. So because my account balance is 186,000, so I'm only use up less than half of my actual account size. Okay, and you can see over here maintenance margin, which means to say that this is the amount that is in my account that's holding up for the maintenance margin. I have excess funds of 100 over thousand, so definitely my account is safe, will not lead into any maintenance margin, any margin call, okay, that will come. Okay, so it's this is for Interactive Brokers. This is how you go and check your margin requirements. And I'm going to share with you the Thinkorswim. For example, Thinkorswim, let's say let's go into a particular stock, right? Let's say Facebook. We can just go to Facebook. Okay, so Facebook currently is at $217. Let's say you want to buy 100 shares of Facebook. So Thinkorswim is quite a good platform. They actually show you how much is going to be locked up in terms of margin. Okay, so let's say you want to buy at this price at 217.79. Anyway, market now is closed. So I'm going to simulate a buy entry. So I right click, buy custom with OCO bracket. So this is something that you're going to learn in the subsequent lessons. Okay, so I will not go into details over here for the OCO order. This will be covered in the later lessons. Okay, so over here I'm just going to share with you. Let's say I'm going to enter 100 shares to buy Apple at 1217.73. So of course we all know that 100 shares of Apple means that you're going to put up $21,773. But does Thinkorswim requires you to put exactly 21,000 plus? So to simulate, right, to know how much margin is going to be put up, lock up in your account, you can click on this confirm and send. So basically when you click confirm and send, your orders will not go through first. It will give you this thing called a confirmation window. So click confirm and send, and you can see that right over here, this thing called the buying power effect. So buying power effect basically means that out of $21,773, how much you need to have that will be blocked up in your account. That means instead of putting $21,773, right, Thinkorswim is only going to lock up $6,500, which is about 25%. I think less than about 25%, 30% of the original trade value. Okay, so the broker doesn't need me to put up entire trade value. I need you to put up fraction. Okay, so that's how you check. Over here, when you look at, if you trade through Thinkorswim, you can look at this thing called the buying power effect of how much margin is being locked up in your account and the resulting buying power. So if after you lock up $6,000, what's the remaining value in your account that you can use to buy stocks or even options? Okay, so it will be reflected over here. Okay, so let's go back to our slides here. So that's for margin. Let's go into trade mechanics. So this is something, this is the fundamentals of trading that I need to cover here. So there's two very important elements in trading: risk reward and win rate. Okay, I'll write over here, right? Risk reward, we call it RR, and this thing called win rate. These two is the fundamentals of trading or even investment. And I always tell people that let's say in the investment or trading, right? If you find something that gives you a very high risk reward, that means basically you can use $1 to make, let's say, more than $5, $10, $20, $30 or more, and your win rate is very high, let's say it's like 90%, you must do this trade all the time. It's what we call a no-brainer. Okay, however, if the risk reward is very high, let's say it's 1:10, but your win rate is only 1%, are you going to do this trade, right? So that's basically how you do a so-called a quick raw judgment of whether you're going to do a particular trade or investment or even business, right? You don't go into a business where you can make a lot of money. You are going to risk $1,000 to make maybe $10,000, but the chance of you winning is very low. You're probably not going to do this business, right? Okay, so the same concept we apply into trading, right? If you can see that, let's say in certain scenario in trading, sometimes you can definitely find yourself opportunities that gives you a high risk reward and a high win rate. And of course, in trading, what we term as a high win rate is somewhere between 50% to 80%. We consider very high, and with a risk reward of at least 1:2. That will be a good trade to be taken by a trader. Okay, so I'll cover more on this later on when we cover more on money management and risk management. So let's first understand what's this thing called a risk reward ratio first. So as the name suggests, the risk reward ratio is a ratio. Okay, it's a ratio. So it's not so much on the dollar value, it's a ratio. So let's say, for example, over here, right, the entry price, let's say you're long at $50. Remember, when we are doing what we are learning in the price action manipulation course over here, we are doing directional trading. Directional trading means it's going to be up or down or flat. Either you win, lose, or draw. It's up, down, or flat. So if you're long at $50, if the price goes down, you have a stop loss at $45. Okay, it means that your risk is $5, right? If the price goes up and let's say your target is at $60, $50 to $60, this is a value of $10, right? So what's the significance of this? Like I mentioned, it's not so much of the dollar value, it's the ratio, the risk reward ratio. So if you are risking $5 to make $10, what's the risk reward? So you're risking 1 in order to make 2. Understand? So that's the thing that we want to know as trader, the risk reward ratio. And you must know that in trading, you need to be invariant with the price. That means it doesn't mean, no, it doesn't really need to care about the price, in the value of the price, right? You doesn't need to care about the price. Even if Amazon is at $1,000 or $2,000, you as a trader, you will still buy high and sell higher. It doesn't mean that it's low price, it's undervalued. It doesn't mean that it's a high price, it's undervalued, it's overvalued. Understand? As traders, we are just going to go in and out. Okay, and most importantly, we judge it through our understanding of risk reward. And then we're going to trade through our using our setups. So in over here, let's say you're long at $50, same thing, your stop loss at $45, you're risking $5. If you're going to take at $65, it means that your reward is $15. So this gives you a risk reward of 1:3. Understand? Not so much of the dollar value. Most importantly, I want you to understand over here, the learning concept here is that to understand the ratio, that's most important. Okay, so in all the strategy structures they're going to learn later on, we have a risk reward of at least, fundamentally at least 1:1.5. That means you're risking 1 to make more than or equals to $1.50 and above. Okay, on average it should be about $2. That means you're risking 1 for 2 at least in short-term trading and even swing trading. Okay, some more mechanics of trading that you need to understand, the lingos that we use. Okay, so when I say that please close out your position, and or we say please square off your position. Square off your position means that you do an equal and an opposite transaction. That means to say that, let's say yesterday you're long Facebook 100 shares. FB is Facebook. Today you sell 100 shares of Facebook. We say that you are square because your net is 0. Okay, simple, right? Okay, how about net position? Let's say yesterday you're long 100 shares of Facebook. Today you only let go 80 shares. You are left with 20 shares. Understand? So we say that your net position is 20 shares. That's the lingo we use. Right? How about liquidity and volume? So liquidity and volume is very much the same. It's used interchangeably. Right? When we say liquidity, it means that the ease of a trader buying and selling a particular asset class. Okay? If the volume is high, okay, you're advised to trade for stocks. For stocks, you're advised, even when you are doing, when I teach you in the subsequent lesson how to do screening, you know that you're going to screen for stocks that has volume of more than 100K. Average volume. So stocks that's an average of 100K volume, regardless of the price, tend to have better liquidity, which means to say that you can buy and sell readily. Understand? So liquidity is very much tied to the level of volume. If the volume is low, definitely the liquidity will be low. You'll tend to see that the bid and ask price of the stock will be wider. Okay, so these are stocks that we tend to avoid. Like penny stock, they are not traded frequently. We call it illiquid penny stock. You definitely will have lower volume and hence the liquidity we say that is poor. You tend to see many gaps in the chart. Okay, so these are some lingos that we use in trading liquidity and volume.